So first off, how many people do you know that have a financial plan or that are motivated to work with a financial advisor if you tell them their return expectation is 5%?
Mhm.
Many people have come to expect higher returns for benchmarks, for if you were to buy the S&P 500, if you were to buy the bond index or what have you. But of course, benchmarks don't have fees. And of course, benchmarks don't have advisors that charge fees. So FP Canada says that in order to plan properly, you have to back out the cost of the product and the cost of the advice. So if the products are, let's say, low cost ETFs that costs, say, 25 basis points on average, that's 1/4 of 1% of return that gets lopped off. Let's say the advisor charges a fairly traditional 1% advisory fee for his or her services. That is a rate of return that almost no one is assuming. And if I could be so bold, represents an existential crisis for the wealth management industry.
This is the Future Ready Advisor, a show about transforming your financial advisory practice. I'm your host, Sam Sivarajan, a wealth management consultant, behavioral scientist, and keynote speaker. In this podcast, I dive deep into the real challenges advisors face and bring you insightful conversations with top industry experts. Together, we'll explore practical strategies grounded in behavioral science to help you better serve your clients, optimize your time, and build a future-ready practice. Hi, everyone. I'm your host, Sam Sivarajan. Welcome to today's episode of the Future Ready Advisor. Today, I'm here with John De Goey, wealth advisor, author, and podcast host. John, welcome to the show.
My pleasure to be here.
Good to have you. Let me quickly introduce you to our audience. John is a passionate advocate for investor rights and client-first practices. As a portfolio manager at Design Securities, he helps families achieve their financial goals. John has a wealth of credentials. Let me share a few. A certified financial planner, certified investment manager, and fellow of FP Canada. John is committed to education, best practices, and transparency. He is also the author of 3 books and the host of the podcast Make Better Wealth Decisions. Twice named one of Canada's top 50 advisors by Wealth Professional magazine, he provides valuable, cost-effective, and diversified investment advice. John, that's a great background. Can you share a bit about your journey in the financial advisory industry?
Sure, Sam. I think I should begin by saying that very few people who actually work in personal finance actually aspired to work in personal finance when they were growing up and in school. For me, I wanted to work in the public service, and I was doing a master's degree in public administration at Carleton in Ottawa. And it's a co-op program. And when I was starting, I was given a chance to work on consumer and corporate affairs, looking into credit card rates and then later into the effect of the GST. And I realized at that age that I was a bit of an advocate. And that was where I got the bug for being a consumer advocate. And so when I moved to Toronto and started as a financial advisor back in 1993, that was always in the back of my mind as to where I was going to go and what I was going to do. So I started in the business in 1993. By the turn of the millennium, I made the determination to move away from commissions to be a fee-based advisor. So that was probably the next major phase in my development. Got the credentials. And after the global financial crisis, as it ended in March of 2009, I realized that there are some real challenges in getting people to do what they ought to do. And it would probably be easier and better if I was a portfolio manager so that I could exercise discretion, because it's one thing to say you're a behavioral coach, but it's difficult to get people to behave like they ought to sometimes. But if I could just go in and automatically do what ought to be done without having to even, get prior commitment, that's a better way to get people from where they are to where they want to go. And I think that helps as well. Along the way, I've written a couple hundred articles, 3 books, as you say, and I've done a fair bit of media things. So I've become advocate and a consumer advocate in parallel with my role, my day job, as I would call it, as a financial advisor. And that brings us to where we are today.
Well, as you say, I didn't know about your master's in public policy, but I can see the parallels between public policy and consumer advocacy. I mean, in many cases, I think there is needs to be a greater awareness of financial literacy and the industry and all of our goals. And I think I've watched you from afar and from a close. I think you've been a tireless advocate for the industry and I think for the consumer. In your podcast and the book, you talk extensively about what you call the optimism bias. Can you describe what that is, how it is developed in the industry, and why you think it poses such a risk for investors?
A simple definition of optimism bias, and by the way, everyone is biased. And by the way, there are dozens, if not hundreds, of biases that we're all subjected to. So it's not like I want to pick on optimism bias, but I wanted to write about it in particular because it is often overlooked and misunderstood, as you suggest. Optimism bias is when people think that bad things won't happen to them. They recognize that bad things happen, but they have this hubristic approach to thinking it won't happen to me. I recognize that people get divorced, but I'm not going to get divorced.
Mhm.
I recognize that people are sometimes in car crashes, but not me. I'm not going to be in a car crash. So that view of acknowledging that bad things will happen, but somehow simultaneously thinking that you're immune because you're special for some unidentified reason is dangerous because now you recognize that there could be a broad macro problem, but you don't stop to reflect upon how it might impact you should it happen to you. And that's really dangerous. And one of the things about biases, and there are many, is that many of them are unconscious. So what I mean by that is a lot of people will be aware and will acknowledge that they have a bias. Everyone has them, but many people are biased in ways that they themselves don't recognize. They don't think they're biased. They are, but they don't think they are. And so when you go through life making decisions when you've got a filter that causes you to look at things a certain way, and that then creates blind spots because you're not considering other alternatives, there's danger there. And I don't want to go into too many details, but that's the short answer.
Look, it's a great point. We do have lots of biases, as you say. Every one of us has them. And we don't have time to get into some of the evolutionary and biological reasons for it. Some of those were good reasons that existed because of our environmental conditions a few thousand years ago, but our human wiring hasn't changed while our environment has. The optimism bias particularly strikes me as something that is potent, and I love the way you described it. And it's everywhere in the industry. In my former life, I was an investment banker, and I remember that equity analysts, for example, I remember seeing a stat that of all of the equity analyst reports that you get, something on the order of 55% of equity ratings, stock ratings are a buy, about 40% is a hold,
Hold.
and 5% is a sell. I mean, and the that strikes me, and I'm sure you and others, as that's optimism bias operating there at a pretty fundamental level.
I strongly agree. I will maybe couch that to give the industry a little bit of leeway. And that is that one of the things that people say about personal finance is that it's not like other elements of business. In business, we have a bias toward action. Don't just stand there, do something. But in investing, a lot of what makes sense is to don't just do something, stand there. Which is to say, there's a evidence shows that you tend to be rewarded for being deliberately inactive. And the joke is that an investment portfolio is like a bar of soap. The less you touch it, the more you touch it, the smaller it gets. And so we have to find ways to leave things alone. So that could be part of the explanation for the 55% buy, the 40% hold, and the 5% sell. But I think so. I'm giving the industry, throwing them a bone to say that could be one explanation. But I'm with you. I think it's highly suspicious that there's so much of a bias toward buying and thinking positively and optimistically about what great things will befall you in life as a result of having bought XYZ stock and just waiting long enough. And I think that is dangerous.
No, you're bang on. And look, we all have the biases in our industry, in every industry. And I think the challenge is to get that balance between action bias, the rush to do something without enough information, and the status quo bias, the temptation to do nothing. And as you rightly put it, particularly in personal finance affairs, that becomes an even more cogent challenge that we all have as advisors and investors. For financial advisors that are aiming to build a future ready practice, what strategies would you recommend for managing optimism bias, both in the advisor themselves and the clients? I mean, part of it is, as you can say, like you don't get clients by being pessimistic. You have to have a solution to the challenges or the pain points that they get. How do you manage that conundrum, if you will?
So the first thing that I will draw attention to is that managing it and getting the client in the first place are different skill sets, because you need to be optimistic enough in order to get clients to come on board to hire you to provide your services. But once you've been hired, you need to be realistic in what their expectations are. And so that can be the same thing. But my experience is that a lot of financial advisors, out of the ordinary business imperative of needing to gather assets, will promise the sun and the stars to their clients. And then, of course, that's great if it helps you to get the client, but then it's not so great when the client expects the sun and the stars from you on a go forward basis for the rest of the relationship because you've set an expectation that you can't adhere to. Let me give you a specific example. FP Canada, which is the organization that confers the CFP mark, puts out annual assumption guidelines at the end of April every year. And it tells you what you should expect in terms of what the CPP benefits will be, what the inflation rate will be, actuarial tables for life expectancy for males and females and couples. But most importantly, in the eyes of many financial planners, it puts out return expectations for
Mhm.
different asset classes. And the 2024 expectations are fairly clear that return expectations for bonds are sort of in the neighborhood of 3 or at the most 4%. And for stocks, it's 6 or 7%. So a balanced portfolio using just ordinary benchmark returns might be expected to return something like 5%. So first off, how many people do you know that have a financial plan or that are motivated to work with a financial advisor if you tell them their return expectation is 5%?
Mhm.
Many people have come to expect higher returns. Many people actually think double-digit returns are reasonable, and they categorically are not. It gets worse. Those return assumptions that I mentioned a moment ago, the 5% for a balanced portfolio, is what you should be expecting as a return for benchmarks for if you were to buy the S&P 500, if you were to buy the bond index or what have you. But of course, benchmarks don't have fees, and of course, benchmarks don't have advisors that charge fees. So FP Canada says that in order to plan properly, you have to back out the cost of the product and the cost of the advice. So if the products are, let's say, low cost ETFs that costs, say, 25 basis points on average, that's 1/4 of 1% of return that gets lopped off. Let's say the advisor charges a fairly traditional 1% advisory fee for his or her services. Now that 5% expected return for a balanced portfolio becomes 3.75% rate of return. That is a rate of return that almost no one is assuming. And if I could be so bold, represents an existential crisis for the wealth management industry. Because as of right now, as of 2024, you can get that kind of return taking no risk at all
Mhm.
by popping your money into a GIC. So the industry, as expected returns have been compressed, are going to have to find new and improved ways to add value. And I'm looking at you, tax optimization and estate planning and behavioral coaching, because the expected return premium that you might be getting from managing money is not likely to cut it if that's your only value proposition.
That's a fantastic point. What do you think about the influx, if you will, of call it high alpha products as a way to offset this lower expected returns on, call it the traditional market? So I'm talking everything from private investments, real estate, etc. Do you see that as playing a role? I'm asking you to generalize. Do you see that as playing a
Sure.
role in people's portfolios, or do you think it's a straw that people are grasping in order to kind of not have that conversation or not have that adaptation of their practice to kind of add value in the way that you are describing through tax optimization, estate
Sure.
planning, behavioral coaching, etc.?
So I'll make a distinction here, Sam, because alpha is a term that refers to beating the market on an absolute and or risk adjusted basis. And I don't believe that's possible in a reliable way. You can get lucky, just like you can win a lottery ticket, but that doesn't mean you can reliably pick lottery numbers. So I don't believe alpha exists. So anyone who has a product that is predicated on the delivery of alpha, I am highly skeptical of. However, I do believe in diversification. And if you have asset classes that are maybe a little bit riskier, but have a higher expected return that are weakly or negatively correlated to other assets that you might otherwise own, well, then that's a reason that I think you should consider those sorts of products and strategies. Because now, if we can extend the so-called efficient frontier, which is the universe of portfolios that you could construct that gets you the highest rate of return, expected return, maybe I should say, for a given amount of risk tolerance, then if using different asset classes or strategies will extend that frontier, even if it's only 20 or 30 or 40 basis points, right now return is very precious and it's hard to come by. And if you can get a slightly better risk adjusted return, I'm all for exploring, what you might be able to do and how you might be able to do it.
No, I think it's a great point. And it reminds me, 20 years ago, I was working at a firm where we had this flagship product that was diversified across a variety of asset classes and geographies, et cetera, had a 10-year track record of something on the order of 12% annualized return and
Mm-hmm.
5% volatility.
Mm-hmm.
So you can imagine 20 years ago, it was selling itself. We didn't really have to do much
Right.
about it. And it worked beautifully until, of course, 2008 when it didn't work anymore. And the point that you make about diversification and the returns being precious, the learning that I got from that was that no model or no product or no approach works in all markets. And this comes back to the role that an advisor can play is to be vigilant on behalf of their clients and ensuring that the portfolio or that the advice or that the plan that they give them is current for the current market circumstances and environment.
Yeah, I agree. And that's one of the things that I lament in bull shift. And one of the things that I lament about the industry is that the industry is so set in its ways, and that might be a status quo bias for the industry in terms of
Mhm.
what proper advice is and what that constitutes and what it looks like, that the industry will say, well, 60/40 is an appropriate portfolio. Okay, I understand. And I understand that strategic asset allocation is critically important. But what are your thoughts about a 60% allocation toward equities when the PE ratio for equity markets is 15? What if the PE ratio is 25? And what if, as it is now in the middle of 2024, we have a cyclically adjusted price earnings ratio for the S&P 500 that's over 35, which is to say, by valuation standards, the U.S. stock market is higher than it has been about 98 or 99% of the
Mhm.
time. It's extremely rare for the stock market to be this expensive, and expensive is a proxy for risky. So I'm all for 60/40, but should we perhaps step back and think critically and say, look, 60/40 is a good general benchmark, but should we at least consider and at least have a discussion about the risk that we're taking by being 60% in a stock market when the stock market is trading at 35 times earnings, which is a different proposition than being 60% in the stock market or stock markets plural when they're trading at 15 times earnings. And that is a consideration that I think the industry oftentimes it's not sufficiently contextual. It just says this is the
Mhm.
right thing to do, and we're going to do it, and we do it all the time, and we don't stop and sit back and assess and say maybe we should be a little more careful now. And I don't see that as much as I believe we should.
I love that. I think this is another example of your optimism bias that you talk
Yeah.
about. It's absolutely bang on. And part of the challenge, and we can have a whole segment about this, is the rather one dimensional view that the industry takes in many cases of what risk is. So, yes, you can talk about risk as volatility, but there's other risks that we're not accurately taking into account when we are saying stay 60/40, even in a historically overvalued market. Now, you, as we mentioned earlier, have your own podcast, Make Better Wealth Decisions. Can you talk a little bit about the focus of that podcast and some of the guests that you've had and what your objective is in terms of what's the message and the focus of that podcast?
Thanks. So, make better wealth decisions is very much predicated on the things that we've just been talking about for the past 3 or 4 minutes. Stopping, reflecting, and say before I just do what everyone does all the time because that's just the way things are done. Let's assess the the universe here, and before we decide, think about whether or not valuations are a consideration, and should we change what we do. And to be clear, given what I was saying even earlier with regard to the bias toward inaction and status quo bias, maybe we don't do anything. It doesn't necessarily mean that we have to do something different. What I'm trying to get people to do as they make better wealth decisions is to contemplate the universe of alternatives so they can make a fulsome decision, thinking about everything, and thinking holistically about their tax situation and their estate planning with their children, and what will the ramifications be, before they just do what they always presumptively thought was the right thing to do without really thinking critically. So I'm trying to get people to make better decisions by thinking critically and challenging assumptions that are rooted in, well, that's just the way we do things around here, which is a lot of what the industry does.
In other words, you mean to get your clients or investors to think and consciously act or not act, as the
Right.
case may be, without
Mhm.
implicitly doing it or not doing it, which is what the default position seems to be in our world.
It is. So that's part of why I became a portfolio manager 15 years ago, is that and again, no one really resists their own ideas, and everyone can be subject to overconfidence. And so, perhaps I'm overconfident as a portfolio manager, but my experience is that many advisors, and this was really rooted in what happened in the global financial crisis of '07 to '09, people say, I have a long-term time horizon, I have XYZ risk tolerance. And then reality strikes, and people realize that, what? You mean stock markets can actually drop by 60%?
Mhm.
And even just what we saw in 2022, what? Stock markets can go down by 20 or 25, and bond markets can lose 15%? Really? Like, a lot of people just didn't think that was possible because of recency bias, because they haven't experienced it
Mhm.
recently, so they don't think about it. So my view is that it's better in my personal practice if I can sort of take the gun out of other people's mouths, because they
Yeah.
will
Yeah.
commit financial suicide if left to their own devices. And it's easier for me to help them to do what's right by simply doing it without having to talk them down from the ledge, without having to get them to say, well, stocks are on sale, they're down by over half, and so a 60/40 portfolio, your $1 million is now down to 700,000, because your 600,000 in stocks is now down to 300,000. What we need to do is we need to take over $100,000 out of your bond position and put it into your stock position. That's what Financial Planning 101 says you should be doing. That's what Portfolio Management 101 says you should be doing. But my experience in 2009 was that it was extremely difficult
Mhm.
to get people to do it.
Mhm.
They knew they should do it. We had talked about it many, many times, but getting people to act when none of their friends or neighbors are doing it. And now we have this herding effect, and no one wants to do it because no one wants to go first. And as a result, inertia sets in, and we don't move forward, even though that is a big part of the brand promise of what advisors say they are offering to their clients.
Look, you're absolutely right. It's hard for anybody to be objective and rational when it comes to their own affairs. I mean, so it's not just on portfolio. We
Right.
see this in other professions. Doctors should never treat themselves. We've seen evidence of cases where doctors have misdiagnosed themselves, thinking that it's a stomach ache when it actually is a heart attack. There's the old saying that a lawyer who represents himself has a
That's a
fool
fool.
for a client. And it's very much in tune with what you're saying. It's not that a doctor is not capable. It's not that a lawyer is not capable. It is when it comes to your own personal affairs or someone close to you's affairs, it is hard for even the most professional of us to stay rational and objective and not give into emotion. And that's what you're bringing to your clients, or what any discretionary portfolio manager is bringing to their client, is that ability to remain a little bit more objective and a little less emotional, because it's not your money that you're managing.
Exactly. And I don't want to overstate it. I'm human too. It's not like I can't make mistakes, or, anyone is prone to mistakes, but I'm hoping that the odds are a little more in your favor if you can provide that objectivity, as you say, combined with experience and the ability to read the room, so to speak.
So technology is becoming increasingly a factor. And how do you see technology playing a role in helping advisors manage biases and make more informed decisions? Do you see this playing a good role, a bad role in terms of some of the optimism and other biases that you talked about?
I see technology as being, first off, it's inevitable. So whether I like it or not, it's going to happen. But the other thing that I would say is that most technology, like anything in life, is only as good as garbage in, garbage out. So as long as the factor inputs are robust, then you would expect the outputs to be good. So, for instance, good financial planning software isn't going to do you a lot of good if you're using unreasonable assumptions, as one example. But when it comes to managing risk, that's where I think is where the rubber hits the road. So regulators in the past 2 or 3 years have been talking about client suitability being run through a ringer with two tests, which is a risk tolerance and risk capacity. And if you can use questionnaires that can do a better job of analyzing risk tolerance and capacity, because those things may, first off, they're different things, and then secondly, we need to manage portfolios to the lower of the two. So if your tolerance is an 8 out of 10 and your capacity is a 6 out of 10, the portfolio should be a
Hmm.
6 out of 10,
Hmm.
because you can't exceed either. You have to, go no further than the most aggressive of the two. And in order to be able to do that, you need to be able to reliably quantify where that threshold is. So good questionnaires that will be more psychometric and not just intuitive, because a lot of the questionnaires that are used even today are not that great, will probably do a better job of using technology to help advisors be compliant, and so they're not offside with regulation, but also helping their clients reach their objectives, because the best portfolio is one you can stick with. And it does you no good if you recommend an 8 out of 10 portfolio and that's relatively aggressive, and the person can't handle an 8 out of 10, either for tolerance or
Exactly.
capacity, and then they bail, and then they move to a 3 out of 10 portfolio because they lost their nerve. And now we're really not going to meet our objectives. Technology is useful, but like anything, it has to be in the right hands, and you have to use it judiciously and appropriately.
That's a great point. Looking ahead, what do you think are the biggest challenges and opportunities for financial advisors in the years in the
Well, I would say the industry needs to think more about evidence and professionalism. So my first book, The Professional Financial Advisor, talked about how the industry is professionalizing, the way doctors, dentists, lawyers, and accountants are professionalizing, and that is continuing, but it happens very, very slowly. And my foolish assumption was that it would professionalize as a result of regulatory reforms that will impose higher professional standards. My experience in the 25 years as an advocate that I've been working as an advocate within the industry since I started writing my first book is that regulation is slow, to the point where instead of leading the industry to being more professional, it tends to lag, and the best advisors and firms push the envelope forward, and regulation changes after maybe 20 or 25% of the early
Mm,
adopters have already moved in. So I think that will continue. I think that's positive. I don't really care how we get things
mhm.
moving forward. As long as we move things forward, that'll be good in terms of best practices. But also with regard to evidence, there's a mountain of evidence that active management doesn't really add value in aggregate. That is understood by ethical and intelligent people, but there are a lot of people who don't really fully appreciate what that involves. So I'll give you one example, and then I'll stop with this. A paper came out about 7 or 8 years ago called "The Misguided Beliefs of Financial Advisors." Now, this was a study that was done. It's an academic study, peer reviewed, published in a learned journal, and it showed that these are now mutual fund registrants. So these are not security advisors, but they looked at 2 dozen of the biggest mutual fund firms in Canada and the advisors, and they had maybe a couple thousand advisors and tens of thousands of client relationships that they looked at in gauging what was actually being recommended. And what they found was that advisors, mutual fund registrants in Canada, chased past performance, were indifferent to product cost, and ran concentrated positions. You're going to say, well, isn't that because there are inherent biases because of embedded compensation or whatever you would say? No, actually, the evidence showed that these advisors did this even with their own accounts and
Mhm.
even after they retired from the business.
Mhm.
So these are people who believe things that are simply not true. And so in terms of the industry moving forward, I think we need to agree on facts. Right now, it seems as though there are even facts, things that should be self-evident, that there are many people who are giving the advice who don't recognize the facts. Imagine in the 1964, the Surgeon General report came out in the U.S. saying that cigarette smoke is dangerous for your health. It's harmful. At the time, there were more there were more physicians smoking in the US per capita than the general population, which is to say, if you were a doctor, you were
Mhm.
more likely to
Mhm.
be a smoker than a non-doctor in the United States in 1964 when the paper came out. So there's a great deal of cognitive dissonance, and the people who are giving the advice were the ones who had to stop and look in the mirror and recognize that perhaps the advice they were giving was not correct and they needed to confront the evidence. And that's really, really hard. But that's where we need to go.
No, that's a great point. I read that paper by Stephen Forster, and I like it, and it informed a lot of my doctoral research. I think you're absolutely right. It was advisors were investing their own portfolios the same way that they're recommending clients. One of the conclusions I took from that, besides what you've just said, is that look, there's a lot of speculation by in the popular press that there was conflicts of interest and everything else, and at least one conclusion I took from that finding was it wasn't a conflict of interest. It was this almost this belief that, look, I'm recommending all of my clients do this because it's the best advice for them because I myself am taking it. So it may be misguided beliefs, but not a conflict of interest, right? And the funny thing
Exactly.
is, I think that we've got a lot of regulations, including now coming out there trying to fight conflict of interest, which, by the way, I totally agree with. Okay. I don't
Yeah.
like conflict of interest, but I think the point that you're making and that the evidence points to is that may be one problem and one problem that we're solving, but there's other issues that we've got, include this idea of misguided beliefs, et cetera, that I think is pernicious in our industry, in every industry, including in the average person
Yeah.
out there. And if we can solve that, I think we make a bigger dent in the people's lives.
Yeah, I strongly agree. I think it's one of those elephants in the room that no one wants to. They think it's a question of wrong incentives or misplaced agency, and it could be those things. And those are bad things. And I certainly want to. I'm with you. I think we should try to root those things out as well. But misguided beliefs is a lot more insidious. It's a lot more counterintuitive, and it is, in my opinion, likely to be more dangerous.
Mhm.
But because you can't obviously identify it, it sort of flies under the radar, and people don't notice it. And one of the things that I would say is that, as an example of that, this paper came out in 2016, late 2016. So it's almost 8 years old now. And the industry hasn't done anything really to disabuse advisors of these misguided beliefs. So
Mhm.
they're aware of the problem. And this is part of what I say regulatory reform takes a long time. Regulators don't seem to be too fussed about this. They would rather talk about the things that we're talking about here in terms of misplaced agency and embedded compensation causing bias with regard to product recommendations, but they're not really doing anything to deal with misguided beliefs. And that's as big as, or in my opinion, actually a bigger problem.
Yeah. And last point, not to beat this dead horse, as you say, it's easier to show action and something that is visible and tracking, as in conflict of interest and compensation, et cetera. You can show the error, you can show the bad behavior, you compensate, you can fix, etc. I think misguided beliefs is under the radar and it requires like academic data and
Yeah.
evidence. It doesn't mean that we should say, okay, because we can't see the problem that we shouldn't solve it. It just means we got to get more creative in trying to identify how we measure the problem and our effectiveness in solving it.
Yep.
So let's go back to the dangers of optimism bias in investment decisions. I'd love it if you can walk us through a practical example of how you think an advisor might approach this with a client's investment strategy.
So as I mentioned a moment ago, regulators are now looking at quantifying risk tolerance and risk capacity and managing building portfolios, making recommendations that take those things into account. So, how do we actually get a handle on what those are? And specifically, how do we fulfill our role as advisors, as behavior modifiers, as behavioral coaches to help people to stick with the plan is really the question. A few things. The most obvious thing, I had Dilip Soman, who's a prof at U of T Bear, talk about this at a client event that I had. He says one of the great things is to have clients to pre-commit, have them put it in writing
Mhm.
that even if the stock market drops by, pick a number, 20, 30%, that I will not sell in a panic and that I will rebalance my portfolio to bring it back to the target asset allocation. So if you can get it committed, get people to commit to it in writing, now it's not now they're making a commitment to themselves. So you make a commitment with your prior self
Mhm.
that when this happens, and you always say, oh, yeah, 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 I will have the resolve moment when you don't actually have to do it. But when the time comes to do it,
Yep.
not so much.
Yep.
One of the things that you can do to help get that pre-commitment in writing is there's two things. One thing I call a lifeboat drill, and one thing I call a pre-mortem. Danny Kahneman talks about a pre-mortem, so let's do that first. Pre-mortem is where you know what a post-mortem is, right? So
Mhm.
when there's a suspicious death and they bring in the coroner and they try to figure out whether or not foul play was involved, and that's the post-mortem. You figure out what caused the person to die, how, why, what were the terms and conditions. A pre-mortem is where you stop and you imagine something not working out. So you're buying this new whiz bang investment and you think it's going to be the next best thing since sliced bread. I'm going to go to my maximum 10% allocation that my portfolio will have for one investment. And I'm going to go right up to 10%. And this is, I think, my a core holding that I'm going to be holding for the next 20 years at least. Okay, great. You can do that. Tell me what it looks like if that investment doesn't work out because it misses multiple earnings reports, because there's been a report of corporate malfeasance, because of whatever. What will you do? And if you can imagine what something going wrong, you might say, well, you might still buy it at 10%, as I say, but you might say, you know what? Maybe I should only put 6% of my portfolio into this because it's maybe I am taking more company specific risk or industry risk or political risk or what have you as a result of going all in on this. So that kind of a purposeful, thoughtful, imagining something going wrong has been shown statistically
Mhm.
to lead to people making better decisions. And then the other thing that I was going to talk about is a lifeboat drill. So one of the things when I started in the business in 1993, yes, I'm that old, was that we would the firm I was at would actually show you $1 million portfolio and actually show you what would happen if, let's say, we have a drawdown like what we had in 1974, or
Mhm.
even a drawdown like what we had in 1982. So we'll show you real numbers based on recent stock market performance, and this is how things drop and how much they drop, and this is how long it'll take you to regain your previous position. Here it is, Mr. Jones. Are you okay with that? You are? Great. Can you sign here, please?
Mhm.
So that we'll put it in your file so
Mhm.
that if something happens, we'll show you that we had this discussion on,
Mhm.
whatever it is, September 20th of 2023. And now it's about a year later. And now the market is not doing so well. And you said just a year ago that you could handle this. So what are we doing here?
Mhm.
And I think forcing people to confront their own limitations and their own prior hubris
Mhm.
is a good way to get them to acknowledge if even if you don't get them to change the behavior, you get them to acknowledge
Yeah.
that they're changing the behavior that they pre-committed to, and that's worth something.
No, I totally agree. It's a failure of imagination on the part of clients. We all have it. It's one thing to sit there and say, oh, well, the markets go down 10 or 20%, and you can nod and say, yep, I'm aware of that. You're aware on a theoretical level, but not on a practical level. Doing that lifeboat drill that you talked about, and I've used something like that in my career, I think it allows clients a better way of visualizing what that actually looks like in dollars and cents, etc. The analogy I use is it's like staging a home. Okay, you know that this is all rented furniture, rented pictures, etc. You should be buying for the physical structure of the house and the location and everything else, but because buyers have a failure of imagination, we give in to staging. And as you say, this isn't necessarily going to stop them from indulging in that misbehavior, if you will, but it will at least give them a moment to pause and think about it. And I think that itself is a huge victory.
I agree.
John, We're coming to the end of our podcast, so I have a few final rapid fire questions for you. So,
Okay.
number one, professionally, what is the most important lesson you've learned over the years?
I would say, and this is going to be controversial, so brace yourself, Sam. I would say that the industry is not as independent as it purports to be. There are lots of firms that say we're independent, but one of the experiences that I've had is that I write articles, and sometimes firms will say, "Well, you can't write that." Well, why not? Well, we don't like what you're saying. And it's like, well, wait a minute, you're independent. We're independent here. This and here's my evidence, and I'll actually show people. So one example will be this misguided beliefs paper. I've shown this, and
Yeah.
other papers. Bill Sharp had a paper that came out in the 1990s called the Arithmetic of Active Management. So I would write an article saying, you've got to be looking at low cost investments because you get what you don't pay for, in the words of John Bogle.
Hmm.
And if you could, reduce your cost by 80 or 90 basis points, that's another way of saying you can
Hmm.
reduce your expected return by 80 or 90 basis points without any change in the risk. That is empirically robust. We've known it for 30 years. But when you try to say it to the public, the industry, which of course makes its money by using active management, will find some excuse to not allow you to say it and still sanctimoniously insist to the world that the industry is independent. So it's not as independent as you think it is.
Interesting. What is one practical tip you would offer listeners keen on applying your insights?
When you are speaking to your advisor, I think you should find the courage to ask for proof. So when the advisor says, "I think you should do this," why is a fair question, and then asking, a second and a third time, and why is that, and is there evidence that supports that? So I did that with my second book, Stand Up to the Financial Services Industry. I put about 30 or 35 different questions in the book to help people to ask those questions. It's a real problem here in Canada. First off, we're very polite. We
Hmm.
don't like to ask
Hmm.
questions. We just But secondly, many people work with an advisor because they don't really know what questions to ask. So
Hmm.
I tell them what questions to ask. But then the third thing that I do is I say, and these are the answers you should be looking for. They should
Yeah.
rhyme
Yep.
with, it won't be verbatim, but this is what you should look for. Because people, A, don't want to ask, don't know what to ask. And even if they ask, wouldn't be able to discern if they were being bullshifted in the answer they were getting, or if they were getting something which was viable and robust. So I think for investors to have a better relationship with their advisor, no one cares more about it than them. It's their money. They have every right to ask, and they should try to hold the advisor accountable to explain what's being. And by the way, you should also try to explain what you own, understand what you own at any rate. So, why this product? Why this strategy? Help me to understand why we don't do it this way, why don't we use that product, and hopefully the advisor will be able to give you an answer that gives you comfort, so that you can move forward with confidence, so that you can take his or her advice next time when the going gets tough.
That's a great point. And I would say the corollary that you implied in there is obviously the advisor should be ready for those types of questions and have that evidence and be proactive in terms of providing that evidence, etc. So if the client isn't going to ask the questions, that they're providing the answers and the data in any case. I think that having a more educated client or investor can only be helpful in the longer run.
We strongly agree. So the other thing that I would add, if a lot of your listeners are going to be pretty smart, and a lot of your advisors that listen are going to be pretty smart, what they might want to do if they want to become more informed with regard to behavioral economics and the advice that you give, is you should maybe read 2 or 3 books about it if you're interested. If you just want to read for fun, you could think of a book from Dan Ariely, Predictably Irrational. But
Great
there are
book.
three more really good books that I would recommend. Thinking Fast and Slow by Daniel Kahneman, a Nobel laureate. Misbehaving by Richard Thaler, a Nobel laureate. And Irrational Exuberance by Robert Schiller,
I
a
know.
Nobel laureate. So I think if you want to read books from people who really understand personal financing and who could bring it home, and one of the things I really love about those books is these guys are really, not only are they very, very smart, they're very compelling as
Mhm.
writers. It's easy to read. It's fun. It's sort of like a John Grisham novel. Like, it doesn't have to be really, really onerous. And if you are interested, I think it's the sort of thing that you can read and actually have fun reading it.
This is great. And I echo all of those book recommendations that you made. They are great. John, this has been fantastic. If people want to find out more about you or your approach or your podcast, where do they go?
You can send me an email. I'm just in the middle of getting a website built, so I don't have a website right now. So first off, the podcast is called Make Better Wealth Decisions. And you can reach me via email at jdegui@designedsecurities.ca. So designed with an ED, securities.ce, I should say.
Awesome. John, thank you for joining us today on the Future Ready Advisor podcast.
My pleasure, Sam. Thanks for having me.
In this episode, I talked with John De Goey about the optimism bias in the financial advisory industry. My 3 key takeaways from this episode are: number 1, the optimism bias and financial decision making. John highlighted the optimism bias as a common pitfall where individuals believe negative events, such as market crashes or personal setbacks, won't happen to them. This mindset can lead to poor financial planning and risk management, making it crucial for advisors to challenge such assumptions. Number 2, the challenge of setting realistic expectations. Financial advisors often promise high returns to attract clients, but John emphasizes the importance of managing expectations realistically. With lower projected returns on investments, advisors need to focus on delivering value through tax optimization, estate planning, and behavioral coaching rather than chasing unrealistic performance. Number 3, the role of technology and evidence-based advice. Technology is a valuable tool in helping advisors assess risk tolerance and capacity more accurately. John advocates for a more evidence-based approach to financial advising, noting that misguided beliefs in the industry, such as the reliance on past performance, can lead to poor decisions. He encourages advisors and clients alike to question assumptions and seek proof in their financial strategies. You've been listening to the Future Ready Advisor. If you enjoyed the show, please leave a review on Apple Podcasts or a rating on Spotify, or share your feedback wherever you listen. Be sure to follow the podcast so you never miss an episode. For more insights on how to keep your practice future ready, visit www.samsivarajan.com. You can find the link on the show notes. There you'll find free tools and resources, along with exclusive bonus content from these podcasts. Thanks for tuning in, and I look forward to sharing more strategies with you in the next episode.